Welcome to this episode number 53 of your next trade, called today Bad Breath. The reason is still the same. We have a market that is going higher, but is mostly driven by very few names. So, as we have been underlining for the last few months and few weeks, macroeconomics are doing fine in the US, where the US GDP is growing around between 1 to 3%, 2% roughly. Europe is doing a bit better. We have some leading indicators, especially for the manufacturing, that seems to be bottoming both in the US and in Europe. Is it going to be a new wave or a new trend in manufacturing? That is very much way too early to say. But what I'm interested in is the equity market. So stocks have been making new highs. We are still into the same trends that we started early in November, and it's very much driven by very few names. So why we have this is we do know that the market weightings is driven by 5 to 30 names, and very much like if we look at this week, if we look at what happened on Friday with the big jump on Amazon and more specifically from Meta, we have quite a bad breath for the equity market. So look at last Friday. On Friday, we had the S&P up 1% and the Nasdaq 1.8% roughly, or 1.7%. And in the meantime, you had more stocks going down on the day than stocks going up. So 50 to 55% of the stocks on Friday were down on the day. So market is very much driven by very few names. The winners take all. This is something again that we have been repeating in 2023. The winners keep on winning, driven by very, very few names, and that make actually your stock picking narrower and narrower. So let's look at the year-to-date asset performance first, looking at how the different indexes, looking at stocks, have been doing. So 4% and 4.1% for the S&P and the Nasdaq. So very much the same. So there is not much of a difference between tech and non-tech. But you see the Russell down 3%, which is explained by small mid-caps that have been struggling. We have some issues with the regional banks that we started midweek. Nikkei, Japan up 8%, so very strong index. We need to take into consideration that the Japanese yen is down 5% on the year. So if you adjust from the currency, actually the Japanese market is more or less up like the US market. If we look now into the commodities, gold, copper, WTI, everything is a bit flattish for the year. Week to date, risk on, still the same story, risk on for stocks. The trend is the same. As we're going to be looking at technical analysis, we are now very close to the top of the range, and we are going into money time. Nikkei still up as we see here, but China down roughly 5% from for the week. So we had a bounce. We bounced by 10% when the Chinese authorities try to push the market higher. We had some weakness for the week, so that's something to be checking, especially because we're going to have the CPI and the PPI midweek in China, but more importantly, we're going to have the Chinese New Year starting next weekend, and it's very important to see how has been the traffic in China and how has been the mood in terms of the Chinese consumer. WTI down big this week, so we had a bit of a hope of a bounce. The week before, even with the noise from the Middle East, we are still, now trading below the $75 for WTI. Year-to-date industry performance, and this one explains as well the bad breath that we have. So S&P, this is what you have here. S&P, you see how many industries that are underperforming the S&P for the year, and very few industries that are outperforming the S&P. In other words, again, very few winners are driving this market. We know, we have been repeating over and over, we are not the only ones. It's pretty obvious that the FANG of this world have been pretty much driving this market, and that tells you that for the stock picking you do have very few names, and that's more or less you're gonna have 10 to 20 names that are very good and 80% of the names that are pretty bad. So week to date industry performance, this is more or less the same. Okay, so this is your S&P, very few winners, many losers. And what you see here, you still get the regional banks that are restarting. So we had an issue with one of the regional bank, which was done massively. They put some provisions looking at 2024, but you have the slowness of the regional banking, unfortunately, because when you have yields that are between 3 to 5%, it's very hard for those banks to keep on doing the same business that when yields were at 0 to 1%. Sectors performance, looking at the year to date and the week to date, so picture is roughly the same. Rates, I'm interested into rates because we have been trading in the US 10 years between 3.8% to 4.2%. So there is a bit of noise, and despite this noise, there has not been like a big move out of this 3.8 to 4%. Now, looking at the next slide, which is, as you know, we always do that from one week to another, which is the Fed fund rates, and I'm comparing the Fed fund rates versus the FOMC meeting that we had in December versus Friday. And you can see that actually December was probably the low in terms of expectations from the Fed, and since then we have been moving higher. So not as dovish as it was a couple of months ago for the Fed expectation. VIX now, volatility. So we have been saying that volatility has been pretty low. We have been saying that we were long call spread on the VIX. If that was not here, that was on the community actually. And actually, sorry for that. VIX has been doing a bottom, and we are now around the 14%. So some kind of a revival on the volatility, not much on the left-hand side, which is for the put. It's mostly for the calls. So that is something to be checking. Volatility a bit bid. We are still at low level, but 14% still around this level. So I'm interested now into looking at not this one, but I'm looking into this one, which is technical analysis, looking at the S&P first through the lenses of the S&P futures. As you can see, we are trending now close to the top of this range. So we are going very close to the 5,000 level on the S&P. I think around the 5,000, 20, 30, you do have like a window of opportunity to go short this market through the futures, through the SPY or whatever. So I've been patient so far. I've been doing some put spread and some call spread on the VIX, not much into the futures or the SPY, and I've been pretty patient. So I think 50-20 could be a good level. Nasdaq, not making new highs, trying to make those new highs. Russell down 3% as we've seen for the year, really underperforming. The big chart is obviously this one, which the FANG, the Meta, the Amazon versus the rest of the market. And as you can see on Friday, we made a massive move. Why? Because Meta was up 20% and Amazon was down 7 to 8%. So that explains the performance of the overall market. That explains why, based on only 40 to 45 names, 45% names, we had the market going higher. CL1 for WTI, bad week. We are back to the level that we had since December. So roughly, the 72, 73 level. Gold, bit of a move, but to be honest, still lacking direction. Copper is the same. So we are waiting for the next catalyst. Dollar has been pretty strong, and that's an understatement. So 108 or below for the euro dollar yen. This is really the one that you should be checking because we are getting close to this 149 level. So that's something that I'll be checking. Not too much to do. Regional banking, you see the weakness. So even if the space is pretty small in terms of market cap now, because we had like massive destruction in 2023, that's the space to be checking, especially going into this week where we don't have that many catalysts going forward. So I'm back into the Excel spreadsheet looking at what happened for the week. So we mentioned last weekend, what were the catalysts. So we had the Treasury QRA. So we had the first, we had the numbers, the big data on Monday at 8 p.m. Then we had before the open on Wednesday, what was the different maturities. But overall, the market digested very well this number. Why? Because we are expecting the Treasury to do less bonds and T-bills over the next 3 months. So the market liked it. What we had here is the sell-off on the FOMC meeting, or what I say, the sell-off. Don't get me wrong, it's a big word because we only went down by 1.5%. So we had a small sell-off after a big rally. Why? Because the Powell, the chairman Powell, said roughly that we should not expect any cut in the March meeting. Now the market, and you can see here, this is the odds of a cut on the March meeting. So we went at the end of mid-December, should I say, which was around the last FOMC meeting, 90 to 90% chance of a 25 bips cut in March to minus 22 at the close of Friday. So more or less very little chance that we're going to have a cut in March. Most market participants are now moving the chances from March into May. So we should expect a cut in May. And if you go back and in time and pause into the Fed fund rates that we have here, so actually I could do exactly the same. You can see that the pricing around May, 5.10 versus 5.33. This is when the Fed is now expecting to cut. So for the week, FOMC meeting, we had better PMIs, as I said, from manufacturing, both from the US and Europe. And we had here, this is Thursday, so big move on Thursday, and then another big move on Friday. So earnings have been pretty helpful. We get the NFP numbers, so this is the NFP numbers where we had job creation over 300,000, so way above the last 3 to 6 months or 6 months average, which are around 150. So US economy still doing very well. We are running 2% GDP. We are running 200,000 job creation and an unemployment rate below 4%. So everything looks really good. If you don't look at the big picture, which is roughly the US economy is having a 5 to 7% deficit for this year. So again, as long as the bond vigilantes don't care and as long as the market is not looking at it, it's going to be fine. But I think it's going to come back in the next 3 to 6 months about this level of deficit. So earnings very good. So here, this is the chart that we have. So we got the Meta, Facebook, Amazon, and actually, as you can see, now we got roughly, instead of having the fabulous 7, we got the fabulous 4. So we're going to have Amazon up 13%. We're going to have Meta up 34% on the year. Microsoft roughly 9%. And Nvidia 33%. And the ones that are not really moving, that will be Google, that will be Tesla, and that will be Apple. So we went from fabulous 7 into the fabulous 4, but those names are really driving the market much higher, both the QQQ, the Nasdaq 100, and the S&P 500. And as we've seen before with the year-to-date asset performances, if you look at the small and mid cap, obviously you don't have those big names and they are really struggling. So going into this week, what we're going to have the ISM services on Monday. So that's for the US. You get the PMI services for the rest of the world. We do know that services have been doing pretty well so far. Now the question is, employment, is it still going to be strong? And as well, what about the prices? Because what we had from the bonds, from the PMI manufacturing in the US and in Europe is activity is better, but you see a bounce in inflation. So does that mean over the next 3 to 5 months or 6 months, could we see a rise in inflation again? And that means the fear of the Fed not cutting rates in the next 6 to 9 months could come again. Other catalysts, we don't have that many. We have some earnings. Okay, so we got 75 issues for the S&P, which are roughly 10% of the market value. You're going to have some Disney of this world. You're going to have some other names. always check the names going forward, check at open interest, and as well, where do we stand in terms of implied volatility. What you can see here, that is an interesting chart from Barclays, and it's very different from a video that we did like 3 or 4 weeks ago. So 3 or 4 weeks ago, the price reaction from stocks was pretty negative. So that was just, when we had the financials. So just after the JP Morgan, Citigroup, most stocks in the US after earnings were down or small flat. Since then, stocks have been doing very well. Both in Europe and the US, but that is happening versus actually numbers. If you look at the number of companies that beat expectations, both in terms of sales and earnings, it's roughly around 70 to 75%, which is a bit below average. So not such a great earnings season, but overall, because we have those very few names that have been very strong, and where the weighting is incredibly big, still, we are talking between 20 to 50%, that is driven the market higher. Seasonality, a bit of seasonality from time to time. So this is the chart here. As you can see in orange, this is the S&P so far for the year. Most of the time, around between mid-February to mid-March, market is a bit weakish. So are we going to have this? So far, market is a hoo-ha-ha phase. Everything is positive. We get the CPI in 10 days. Then we get NVIDIA. And we're going to have some option expiry. So potentially some weakness to expect. I think there are some trades that are offering great risk rewards, and otherwise, what about the implied volatility, the implied move for the week for the S&P? We are talking 1.2% for the week. So pretty much, I'm sorry, the same picture as before. Economy is doing fine. GDP, unemployment, manufacturing doing better. So we are talking 1 to 2% versus a deficit again that is running at 5 to 7%. That explains the market doing the same. We are talking stocks, moving higher and higher on very few names, and other asset classes kind of trading in the range for the last few weeks. So we are waiting for the next catalyst. So you have a lot of noise coming from the Middle East, and in the meantime, market is very fine with it, with a caveat where the volatility is a bit higher than it was 2 or 3 weeks ago. So this is for me today. If you want to join the community, you're going to have same as before. So we have Discord community, 3 channels that are pretty active. We got more and more people active. If you've done the 4x4 or the mentoring, you will have access to 20 more channels. And this is it for me today. If you got comments, put them, and I try to reply to them as quickly as possible. Have a good trading week. Bye-bye.